You're never too young to start creating wealth. We have helpful tips for young adults to begin creating their nest egg now. Then, looking for a mortgage? Advice from mortgage expert Jodie Kristian will ensure you get the best mortgage possible. And learn how your RIF withdrawals may impact your tax rate. All this and more on The Wealthy Life. What is the #1 thing teenagers need to know about finances?
This is so important. They to know about how to save money and how to make good investment.
Ooh, doing taxes, for sure. Because they don't really teach that in the school curriculum. Well, not when I went to school.
To always save up money just in case like anything goes wrong.
Start saving early. It goes quicker than you think.
Today's guests are teenage bloggers Marley, Vienna, and Rebecca, curious about getting ahead financially. Ladies, welcome to the show.
Thank you so much.
I love your energy.
Thank you.
I am so curious to know your story. How did you three meet?
We actually met at school. We've been going to the same school since kindergarten our whole lives, and we've been best friends since grade 6.
Now that doesn't happen every day. Usually people grow apart. What's kept you together?
Similar interests for sure. Like, we all enjoy fashion and travel, which has been what our blog has been about. Yeah.
So you're bloggers. I want to know, how did that come to be? Rebecca, how did you guys start blogging together?
Yeah, well, Marley and Vienna started one night when they were sleeping over together, and they just wanted to start a blog, and a few years later I joined them, and now we blog about lifestyle things like fashion and beauty and travel and healthy recipes and stuff.
Yeah.
So for the old people like me, I need to know, what exactly is blogging? I need to know.
So we actually just write some posts online about whatever we're passionate about, like fashion or skincare, recipes and stuff, and then we post them online and people can read about them.
Yeah, and on our social medias, people can find us there and then link to our website.
That's where we'll promote it and stuff, and lots of pictures.
What's your favorite thing to blog about?
That's a good question.
Probably traveling, because it's just so different. Each post, you can post about something totally different.
Yeah. I really enjoy taking pictures when I go traveling, so just to like see all the pictures that we each took and whatever. It's
Always something new and different.
Yeah.
So does this mean that you need to talk your parents into taking you on trips way more often?
Definitely.
Yes.
Who pays for these holidays?
Right now our parents, but hopefully in the future we can start paying for our own trips and traveling a lot more.
Yes.
Well, you just think your parents are doing you a favor. They're setting you up for life, right?
Totally.
They're giving you good experiences so that you can blog and hopefully start making some money. Do you make money blogging?
We make a bit, not enough for the three of us to be like full-time bloggers to live off of, so we each have our own like summer jobs and stuff, but we're trying to make some.
We're starting,
So how do you make money blogging? Vienna, where's the money come from?
It comes from us promoting people's products on our blog or on Instagram, as well as taking pictures for different companies for them to use.
Oh, great. So you've got a little income stream coming in.
Yeah, a little bit.
What do you do with the money now?
Right now, it just sits in a bank account until we maybe can afford to travel somewhere and use the money.
Yeah, or we'll like sometimes put that money towards things that we need for our blog. Like, you know, we needed an SD card, so we went and bought one, or
New lights or something.
Yeah,
for
yeah.
pictures.
So how do you decide who's going to spend the money on what? Do you always agree on where it's going?
Pretty much, yes. We kind of have little blog meetings and we meet together and agree on things.
Decide
So
if-
far, so good. But this is a real taste of what it's like to be in business with somebody else. I mean, you three essentially are business partners.
Yes.
Yeah.
Do you have a business partnership agreement?
We do actually, yeah.
What?
It's called our friendship agreement. So
we started
set
it
out,
when we had our blog.
Yeah, we set out a bunch of like guidelines, like
Ground
a
rules.
certain amount of money stays in our bank account all the time, and like what happens if our like
Somebody
we
wants to
split
quit,
up
yeah.
and like.
I am so impressed. That is like one of the biggest mistakes business owners make is they don't put things in writing, and you're ahead of the game. The friendship agreement. I love it. I love it. So ladies, what's your big question for me today?
What money tips do you have for us to set us up for life?
Oh, that's right up my alley. Don't go away. Learn the top money habits to create wealth when we return.
The Wealthy Life is brought to you by investment dealer Raymond James. Life well planned. See what a Raymond James advisor can do for you.
Welcome back. We're here with teenage bloggers Marley, Vienna, and Rebecca to learn good money habits to set them up for life. Ladies, I have to say, I'm so impressed. The three of you met at a young age. You formed this business partnership together, you're blogging, and you're actually generating some income from it. And now you want to know, what are some tips to set you up for life financially?
Yeah.
Just asking that question at this age, I have a good feeling you guys are going to be financially well off when you're older. So before I tell you those 3 secret tips, I want to know if you have good money habits already. Are any of you savers?
I am. I save a little bit.
Rebecca's the saver, so I'm going to assume that Vienna and Marley are the spenders. Okay, well, I'm going to show you a little example of what compounding growth can do for you. So, you're all 17 years old. You two are going to be the spenders. So you're going to spend $1,800 a year every single year on whatever you want until you're 25. What are you going to spend the money on?
Probably
Makeup.
clothes and makeup and shoes.
Yeah.
Well, that sounds fun. Meanwhile, Rebecca is the saver, and you're going to put your $1,800 a month in an investment account.
Sounds good.
Now, as time goes on, you turn 18, 19, 20. Rebecca's starting to get annoyed because you two look really good. You've got hip new shoes, clothes, makeup, and she's been the saving but doesn't have anything but money in the bank to show for it. You two, on the other hand, say, wait a minute, Rebecca, she's saving a lot of money. You watch her bank account grow and you've got nothing but clothes that no longer fit or aren't in fashion anymore to show for it. So at age 25, you're going to switch roles. Rebecca, you are now going to spend away. You're going to spend $1,800 a year every year until you're 50. And you two are going to try and catch up to her. So you're going to save $1,800 every single year from age 25 to age 50. Now we're going to fast forward and you're 50 years old. Wow. You guys look good. Who's got more money? You two saved for 7 years. No, you two spent for 7 years. You two saved for 25 years. Rebecca saved for 7 years. Who has more money at age 50?
They do, obviously.
Yeah.
You have the same amount.
What?
If you invest your money early, and if you can earn an average rate of return of 8% on your money, now that would be a diversified stock portfolio, we'll get to that later, then compounding growth, by starting 7 years earlier, Rebecca only had to save for 7 years. You two had to save for 25 years to end up with the same amount, which is about $131,000 at age 50.
Wow.
So that ties me into what my 3 big tips are for you. Number 1, earn money now. Start today. You guys are already doing that with your blogging and some summer jobs, so that's awesome. Tip number 2, only spend what you have. Don't go into debt. And tip number 3 is invest now. Don't spend it all. Take some of that hard-earned money every time and make sure you put it in an investment account so it can compound and grow for you over time. Does that sound easy?
It sounds doable. Yeah.
So do you think, hearing that story, are you two spenders motivated to save?
Yes.
Definitely.
Now, you're not going to start spending, are you?
No, not after that story.
You have to have a balance of the two. Well, ladies, it's been awesome having you on the show today. Thanks for coming.
Thank you so much.
And stay tuned, what you need to know about getting the best mortgage after the break.
The Wealthy Life is brought to you by investment dealer Raymond James. Life well planned. See what a Raymond James advisor can do for you.
With us today is mortgage consultant Jodie Kristian. We're going to learn how to get the best mortgage possible. Jodie, welcome to the show.
Thank you. It's nice to be here.
Even though you woke up this morning with a bit of laryngitis.
Yes, my apologies for my scratchy voice.
That's
it's nice
okay.
To be here, though.
We'll still get all the good content out of you.
For sure.
So tell me a little bit about your background. How did you get into the mortgage business?
Well, I got my degree in sociology with the intent of working in the social work field, and it didn't really pay me enough to pay the rent. So I decided to supplement my income by working at different law firms that were very real estate focused. I worked in the conveyancing department putting together mortgages, and eventually just decided to get my mortgage broker's license.
Oh, and are you loving it?
I'm loving it. Yes, that was over 18 years ago, and it's been a really good career.
So after 18 years in the business, I think you know a thing or two about getting a good mortgage.
I would hope so.
So the rules are always changing. What do people need to know today? What has changed recently?
Well, in the last year, and specifically in the fall of 2016, the federal government changed the rules for qualifying. They implemented what is called a stress test. That stress test applies to anybody buying a home with less than 20% down. If you have less than 20% down, you have to qualify at the Bank of Canada's 5-year posted rate, which is just about double the actual rate you would pay in the market today.
Oh, that's a great safety net. So by qualifying for a mortgage at a higher rate, it means that the amount you can borrow is less, essentially.
It's about 20 to 30% less.
So
it's significant.
Unless you have 20% down, you're just going to have to get used to that. And I think why that protection is important is if interest rates start going up, we don't want to go through another 2008, 2009 crisis.
Totally.
We don't want to go through that again.
Totally. That is one of the reasons. Another reason is that the federal government has looked at the way housing has increased across Canada over the last 2 years, and they're concerned that we may have a housing bubble. And so they're trying to slow housing down by making it harder to qualify for mortgages. I mean, let's face it, these are ultra low rates. And if you're qualifying at 2.5%, you qualify for a whole lot more mortgage money than if you're qualifying at just about 5%.
And housing prices change over time. They go up and down. We get into bubbles. We get into low periods. Interest rates change over time. When people are deciding how much they can afford, I think it's a very good idea. Pretend rates are way higher than they are today. Make sure you can still afford the payments and not get kicked out of your house. Totally. That would be terrible. Yeah. How about amortization periods? How long can people amortize their mortgage for?
You can amortize a mortgage up to 35 years today. Most banks are 30 years as long as you have 20% down, and we still have a couple of lenders that are going 35 years. You still have to qualify on a 30-year amortization, but we do have the option of going up to 35 years.
Now, a longer amortization period makes sense in some cases, and in others it doesn't. I mean, if you're young and you're just getting into the market and you're not going to retire for 35 years and your goal is to pay off your house when you retire, that's fine. The other time I see it handy is when people are retired and they're looking for extra income in retirement and they maybe still have a mortgage. Rather than worrying about paying it off so quick, amortize it over a longer period, invest the difference, and then you've got some extra cash flow.
Exactly. We help out a lot of homeowners that have a ton of equity in their home, but because the housing is so expensive here, or maybe they help their children through university, they're still carrying a small mortgage. And because their retirement income, they have other uses for it, or maybe their retirement income is quite low, they want to either pay interest only, which is an option,
yes,
or they can extend the amortization to 30 or 35 years. It's very helpful for some families.
What do first-time home buyers need to know?
I think first-time home buyers first and foremost need to know what they're pre-approved for and what the costs of going into a mortgage are. Not just the cost of the mortgage, but your property taxes, your heating costs. They should know legal fees. And
maintenance. I mean, when you're
Absolutely.
a homeowner, you know, you need something fixed. You can't just call the landlord anymore.
Totally. They should have a slush fund that they can dip into in case something goes wrong with the house.
How much do they need to put down?
The minimum down payment for first-time home buyers or any type of home buyer that is going to own or occupy the home is 5% of the purchase price, up to a purchase price of $500,000. If your purchase price exceeds $500,000, the down payment must be 10% of any increase.
Wow, so they're really, I don't remember that from 20 years ago when I bought my home.
Yeah, that changed in the last year.
Now, if you only put 5% down on a house, then you need CMHC insurance. I believe if it's anything under, is it 20%?
Correct, yes.
So CMHC insurance, if I only put 5% down, how much is that going to cost me?
It's 4% of your mortgage, and that insurance premium is added onto your mortgage. So essentially, once you add the premium on, and you're only putting 5% down, you're almost mortgage rate for the maximum price.
Yeah, you've got a whopping 1% equity in your home when you get started, even though you put 5% down.
Definitely. If you can afford to put 10% down, the premium drops by about 1%, and it continues to drop as you put more and more down, to the point that if you put 20% down, there is no premium.
Okay, now you know what? Something else that gets to me is people are always chasing the lowest rate. Is the lowest rate always the best thing to go for?
You know what? Rate is really important. Having said that, it's not always the best thing to go for. You need to know that some of the ultra low rates out there come with what we call a no-frills mortgage. And that basically means that you may have very limited prepayment privileges.
Yes.
The penalty to get out before the end of the term could be something like 3% of the balance of the mortgage.
Wow, that could be substantial.
As opposed to paying interest only, or 3-month simple interest to get out of a mortgage. And some lenders even restrict whether or not you can pay out that mortgage at all unless they sell the home.
Okay, so you need to think about this, and you need to know all your facts before you sign on the dotted line. I know a friend of mine had a mortgage and wasn't planning on moving for 5 years, but ended up selling the house because she saw something she liked better. Her mortgage didn't have all the right provisions in it, so she couldn't port it with her. She couldn't transfer it over to her new property. So she had to pay thousands of dollars in fees, and the cost and fees way exceeded any slight interest savings on the rate.
Yeah, you really need to watch out for that. And that's why it's so important to work with someone, a banker or a mortgage specialist that you trust, to give you, all the ins and outs and go over the fine print with you. Don't just look at the fine print. It goes, in one ear and out the other. Ask questions, ask tons of questions.
So make sure you know everything you need to know, and hopefully, thank you for this. This has been very helpful, but hopefully people will know that before they sign. And if you want to know how much you can qualify for or how much your payments will be, go to thewealthylife.com, send us an email, and we'll send you a link to the calculators. Jodie, thank you so much for being on the show today.
Thank you very much for having me. It's been a pleasure.
And when we return, find out how RIF withdrawals impact your tax rate. Welcome back. Thanks for your letters, emails, tweets, and messages. Today's question is from Marcel in Vancouver. Dear Sybil, I am 65 years old and still working. I have about $120,000 in RSPs and continue to contribute $500 monthly. I also put $500 a month into a TFSA. I must roll my RSP to a RIF at age 71. I was thinking that I would need to take $1,000 a month from my RIF to pay rent, food, etc. What will my tax rate be? How long will my money last? I'm not sure I could live on less as I live in Vancouver and the cost of living is high. I hope you can assist. Kind regards, Marcel. Well, Marcel, great job in saving and continuing to save, but please do not retire until you have a financial plan. If you're worried about cash flow now, you're not quite ready yet. Great to hear you're still working and saving, so maybe you extend your retirement a few more years. Or, because the cost of living in Vancouver is so high, maybe you should look and consider living in another area. All that being said, let me explain how your RIF works. You have to convert your RSP to a RIF by the end of the year you turn 71. But your first withdrawal doesn't need to happen until the end of the year you turn 72. The amount you withdraw every year, there's no maximum. You can amortize it over the rest of your expected life, or you could set a fixed amount until it runs out. The choice is yours. When it comes to tax rate, all withdrawals are issued a T4 RIF. So that income just gets added to your income return for the year, and you will be taxed at whatever your marginal tax rate is. So before you do anything further, that one piece of advice is get a retirement income projection done. And that wraps up this edition of The Wealthy Life, helping Canadians make smart financial decisions. Join the conversation on social media and tell us your story. Go to thewealthylife.com to ask your financial question and make the most out of what you have.